Now let's talk about the signs that our economy is shaky. It's on shaky ground. The first big crack, and one of the biggest tellers, is rising auto repossessions. That's right. Car repossessions have surged to their highest level since 2008 financial crisis, with 6.4% of subprime borrowers at least 60 days behind on payments. That's double the 2021 rate. And economists warn that this is serious because car loans are typically the bills people are least expected to skip. Why? Because they can get away with not paying their rent, but they can't get away without paying their car bill because they use their car all the time. They use their car to get to work. They use their car for entertainment. So if consumers are skipping auto payments, that is a sure sign of economic weakness on the consumer's part. The second thing is we have a weak labor market. That's right. For 2 of the last 3 months, the ADP, the private sector jobs report, has shown declines. First time we've seen that since the beginning of COVID. And then the Bureau of Labor and Statistics jobs report, which we missed this last month because of the government shutdown, has also shown a negative number over the last month that was reported. And there are more companies that are laying off employees. Matter of fact, not including the administration basically riffing a bunch of federal jobs, Target just announced an 8% decrease in employment over the course of the next several months, and other companies are following suit. The fact that AI and automation is taking many of these jobs away is something that we need to continue to pay attention to. But I will say this, that the labor market is weakening right now. The third thing that we're seeing is an inverted yield curve and credit tightening. The Treasury yield curve remains about 23% inverted, historically one of the strongest predictors of a recession. Meanwhile, a credit-based recession probability has increased, nearly doubled since January, as banks continue to tighten their lending standards. And also loan delinquencies, as we talked about with auto recessions, but loan delinquencies continue to rise. Here's the number 4, the falling consumer confidence and spending. The Conference Board's Consumer Confidence Index dropped to 97.4, with the expectation component falling even more sharply down to 74.8. Personal spending has flattened, suggesting that households are starting to conserve cash amid worries about job security and inflation. The middle and lower class right now are on the struggle bus with their credit. The only people who are spending right now are the people who are in that upper 10% or the upper class. And then finally, we have weak industrial manufacturing output. Industrial production fell 0.1% in July, and the U.S. leading economic index logged its steepest drop since early 2025. Manufacturing new orders and average work hours declined, both consistent with an economy showing across multiple sectors. So each of these trends, from household distress to slowing factories, points toward a fragile economy, possible stagflation, and maybe even a recession as we head to the end of 2025.